Hi, welcome to this live webinar. Today we're talking about tax residency at the half year. So we're coming up to the end of June, which is halfway through the year, or is it? Let's consider that. If you count the number of days from the 1st of January, then over the weekend we get to 183 days. Now Monday is the 4th of July. The 4th of July is Independence Day for the Americans, and there's not an insignificant connection there. So if you leave the UK on the 1st of January, then the 4th of July is your first day of freedom as a tax resident in another country. The day of travel not being a tax day. So, there is a bit of a significance there. So 4th of July, if you have lived in a tax residency with a calendar year tax year from the 1st of January that you arrived, then over the weekend, going up to the 4th of July, you become a tax resident of that jurisdiction. And that is your independence from being a tax resident in the UK. Or is it? These things are never straightforward, because obviously the UK has the old Easter New Year tax year start, which has never been changed despite the 300 years that have intervened. So if you've been a tax resident since you left the UK on the 1st of January, you've got 2 tax years to be involved with. You've got last year's to the 5th of April and the new current tax year. So any income, any capital gains, any rental income, dividends, royalties that you've received over this period so far could still be subject to tax in the UK. Now, there's all different mechanisms that we need to get into. So in July, we're going to celebrate tax independence and non-resident status by looking at these in 4 deep dives with our live webinar series. So we'll look a bit more at tax residency next week, then dual residency, then we'll look at split year treatment as well, and what the implications of that, as well as non-residency. So the next 4 weeks are tax residency, dual residency, non-residency, and split year. And so subscribe to our YouTube channel here now, like it and share it with people that you feel might be interested to look at that in more detail. Got a lot to celebrate with your tax independence, but if you're already back in the UK, then you're already potentially liable to be tax resident in the UK for the rest of the year. So that comes up with days in country and what your trips are. Under international law, a short trip, a short business or holiday trip under 90 days it means you're still tax resident in the first country. You have to look at the overall picture to get the full picture, because dual taxation can apply. So a UK expat could be taxed, required to do a tax return in the UK as well as abroad at the same time, if you do potentially paying tax in both jurisdictions. A double taxation treaty really ensures that you don't pay tax twice. But if the UK or your tax resident country have got a high rate of tax, that will be the tax that you pay. So you need to consider these different types of incomes. Some incomes are fixed and some are movable. And then also we need to take a deeper look at service pensions. Under the new international standard of double taxation treaty, government service pensions can be taxed in the home country. So a UK expat with the civil service or forces or civil service pension will have that taxed in the UK at some point in the future under the new double taxation treaties. Cyprus and the UK, for example, signed that new updated double taxation treaty in 2018. and it came into force in 2019 with a transition period through to 24, 25 tax year. So we need to have a deeper look to consider what is income that's fixed in one country, whether it's Spain or Portugal or Cyprus or France, what income or gain is movable with you and taxed in your country of residence, and also consider what special conditions might apply to certain types of income that mean they're going to be taxed, such as a service pension, government service pension. Tax residence depends on a number of different factors, whether you're a family or a business. Now, under the current way that law works, and this may not have been the case if you went expat 10, 20 years ago, but you have to have your residency permit before you can get a tax number. So in the old days, you could go and work in a country and maybe pay tax and be on the payroll without having a residency permit, especially with the EU movement. Even within the EU, although you've got freedom of movement, you have to have your local residency permit to then get your social insurance and tax residency numbers. So those are things that we need to look out for. If you're a business, you need to have a permanent establishment in that location. But what is a permanent establishment? It's not necessarily paying somebody abroad. It's having a branch office or a residential address, a residency there. So there are many things to consider over the next month. So look out for those webinars on tax residency, dual taxation, as well as split year and non-resident status. We've got a lot to celebrate this weekend, potentially. For calendar year tax residents, it's Independence Day. You're either tax resident in this country or you're not, or you need to take action about how to progress matters going forward. What are your liabilities in your home country and in your country of residence? So much to celebrate. So have a good old American IPA. Think about your questions and contact us at productpartnership.com with your questions, and we'll answer that for you. We offer free reviews to any new inquiries from clients overseas, or you can subscribe and get online advice and guidance for completing returns. Thanks very much for listening. Don't forget, if you haven't already subscribed to our channel, subscribe now, and keep in touch with our upcoming tax residency, dual taxation, non-residency and split year live webinars in the month of July, independence and tax freedom time.